Welcome to the Taxing Subjects Podcast. I'm Ryan Norton, and today I'm joined by CPA LaDonna Keener, who is also Drake Software's manager of the Federal Business Tax Group. Welcome to the show, LaDonna.
Thank you. Glad to be here.
We're very glad to have you because today we're going to talk about the Tax Cuts and Jobs Act specific to corporate tax changes. Most of the tax changes take effect tax year 2018. And that means, of course, that there'll be a lot of people in continuing education classrooms trying to figure out what they need to know before they step in the office in January. So let's just kind of jump right into it.
Okay.
All right. For those who might not be aware, what did the Tax Cuts and Jobs Act do to corporate tax rates?
What it did for the first time since the 1986 Tax Act, for years corporate tax rates were very straightforward. It was a graduated scale,
Right.
and you pay taxes based on your income level. And for the first time ever that I have seen, now it's going to a flat tax rate of 21%. So it simplifies it to some extent. Some people will see a tax go up, other people will see a significant tax savings.
What happens for those fiscal year C Corps?
Okay, so the interesting aspect of this tax rate change was it basically went into effect at January 1, 2018. So it affected the fiscal year filers whose tax years actually include the January 1st, 2018 date. So the IRS had to put their heads together and come up with a battle plan and some worksheets, and they came up with a blended tax rate. So basically, in Drake Software, if you're doing the return in 17 and your fiscal year goes over the January 1st date, you're going to see a blended tax rate form. And they look at the number of days you were in the prior year, 2017, the number of days you're in 18. They do this little proration, and we give you some nice worksheets to look at. But it's a calculation difference. And if you think about it, what some people saw is, let's just say, for example, if you had taxable income of $100,000, so in 2017, the amount of income tax you would have paid is $22,250.
Right.
But at 21%, it's very obvious. The math is easy. It's $21,000. So
Right.
it's a kind of a high number before it actually starts going down. So some people may actually see on the same amount of income paying a little bit more tax than they did in the prior year, which is interesting. I don't know if everybody expects that, but that is what will happen.
That will be interesting. And then also, what about the alternative minimum tax?
Alternative minimum tax is gone for corporations. Not true for 1040, but it is true for corporations. And that actually happened on the blended, so we actually had to do a blended tax rate for alt min too. So
Why is there going to have to be a blended tax rate this year? What did it bring that about?
basically, when they wrote the original bill, I think the intent was to start the new tax rate for a tax year beginning after January 1st, 2018. Unfortunately, when the final law was written, that was not done. And so there was a lot of confusion in the tax profession, and that's why probably most individuals and preparers did not see anything come about till, say, March, late March, because it took the IRS that long to figure out how they were going to handle it. So sometimes they have to react, and a law is a law. So the
Right.
IRS has to do the best they can to put the law in place.
Right.
And so that was their solution.
And I don't know that they would be able to get a tax law change passed through right now. I'm not sure that would be a possibility.
No, I didn't. It's going to be an interesting year. It's going to be an interesting year for the IRS. It's going to be an interesting year for Congress. It's going to be interesting for all of us.
Absolutely. Let's shift gears a little bit. Let's talk about depreciation. What are some changes to depreciation that listeners would want to know about?
Okay. Depreciation is one of those things that has a tendency to change quite a bit from year to year. So most people and I would encourage you to continue to do that. Always kind of keep an eye out on law changes and interpretations by the IRS, because depreciation does change from year to year. One of the big changes was 100% bonus depreciation. Now, 100% bonus is interesting because it affected 2017 filers. And how it affected 2017 filers is, for whatever reason, it went into effect September 28th, 2017.
Huh.
It was a retroactive thing.
Yeah.
So it was signed in December, but retroactively went into effect. It was kind of a big call generator for us in 17 because people didn't understand. The prior law was a 50% bonus, and all of a sudden people were getting 100% bonuses on assets that were purchased after September 27th. So
They thought it was an error. But
they thought it
in
was
fact
an
it
error,
wasn't.
but then come to find out the tax law change affected those filers. That was a big one, and that will continue as in 18 in the future. And then the 179, the limit went from a $500,000 limit to $1 million, and the phase out went from $2 million to $2,500,000, and that will be indexed for inflation. So that's a big increase for everyone. There'll be a lot that we'll be able to write off as preparers.
Yeah.
So.
Now, with the 179, didn't they add, they adjusted how things that were considered applicable, or let me rephrase that. They adjusted those things that were affected by the 179, did they not?
They did. In the past, there was a limit on the number of years you could do certain property, and they created a type of real property, qualified investment property, qualified leasehold property, qualified restaurant property, and what they did is they allowed you to depreciate them at a much shorter time. So it was a 15-year rate, and by that they actually qualified for other things like bonus depreciation. Those all three went away, and now it's just qualified improvement property, and it's a new type. Unfortunately, when the law was written, they failed to reduce the time on that to the 15-year. So now it's still much longer than what everyone expects. So I do think there will be a correction on that. I think that there will be some intent in the. There's been too much talk about it. I've seen a lot of talk on the internet from various taxing subjects and different things like that. And it'll happen. It'll get fixed, I believe. So, but it's a big deal for especially for like the restaurant business, people like that.
Sure.
So.
What about changes to the corporate-related deductions, like net operating losses?
NOLs are very interesting because NOLs actually changed. The prior law allowed you to carry back 2 years and then carry forward 20. And basically the law change was no longer is there a carryback. That'll actually eliminate a few forms in the corporate package, which is, less forms make me happier, but that doesn't always make everyone happier because we bill for these things. But it will be carried forward indefinitely. So the only caveat to that is in the past you were able to deduct 100% of the NOL against income. As long as you had income, that would allow it. Now it's going to be limited to 80%. So for an example, if in 2018 you had a $90,000 loss and you're carrying it forward to 2019, and in 19 you had a $100,000 income, pre-law would have allowed you to deduct the full $90,000. You would only pay tax on $10,000. Now the law says it's limited to 80%, so you can only deduct $80,000, and you would be paying tax on $20,000. So you'll never get completely down to zero from an NOL.
Got it. What about? I've also heard about some changes to deductions for entertainment and business meals. Could you talk about that a little bit?
There isn't a change on the entertainment side. Now, It's not 100% clear if the IRS or the Congress intended for the business meals to be to go away, and the general belief is they're there to stay. There's still the 50% deduction on your meal section, but entertainment is no longer allowed. And that's for entertainment expenses that you incur after December 31st, 2017. So if you're a 2017 fiscal year corporate filer, you're going to have to watch, and you're probably going to have to ask your clients, when did these expenses occur? Because you're not supposed to deduct them if they occurred after January 1st.
Now, are there any types of entertainment expenses that could be written off at all?
There are exceptions. There's almost always exceptions to some of these rules. And I think there's 6 or 7 exceptions listed, and I would recommend people go to the TCJA, the Tax Cut Jobs Act rules, and look at them. Most of them apply to like employees. Say if you provide meals for your employees on the premises, you can still deduct that.
Right.
If you sponsor a booth at a sporting event, you can still deduct that. You just can't deduct the box that you bought at the sporting event so you can entertain your clients at it.
That's going to hurt me this year.
Yeah, it's a sad, sad day. For someone out there, it's a very sad day.
And what's changed regarding DPAD?
Domestic production activities deduction, which is a deduction that a lot of people like to use. It affects the construction industry, manufacturing, oil and gas. It's gone. It's just gone.
Just gone.
It is just gone. There's a little bit of a carryover for what we call some patronage, which relates to co-ops. Mm-hmm. But beyond that, it's gone. And that's just a transition thing. Mm. Once that's done, it's gone. So
say goodbye to DPAD.
Goodbye to DPAD.
I guess we're going to keep shifting gears like we're just driving down the road.
Sure.
What has changed for real property?
Well, we talked about the depreciation things earlier, but I wanted to talk about the change in real property as it affects when you're doing a like-kind exchange. And there were some serious changes to like-kind exchanges. Basically what happened is like-kind exchanges from 2018 on are restricted to real property only, and it can only be real property that's not not available for resale. So if you're in the business of selling lots, you're not going to be able to do like-kind exchanges for those types of property. But if it's investment property, you could still do it. Mm-hmm. Where it's going to hurt a lot of people, especially the small business person, is we're used to handling when we trade in vehicles and that type of thing as a like-kind exchange.
Right.
It's no longer a like-kind exchange. It's basically a sale. You've sold the asset. Even though you traded it in, it's considered a sale. And you will be recognized in either a gain or loss. It could be a good thing, it could be a bad thing, but you are recognizing either a gain or loss on the trade-in.
I think we have just a couple more things. I'll look through my notes here. Just one more, looks
okay.
like. Well, first, I do want to thank you again.
Sure.
And I'd be remiss if I didn't remind the audience that you are a CPA in addition to
correct
your position with Drake. Mm-hmm. So we do have a legit authority on the subject here today. But before we do sign off, could you briefly talk about just some changes in accounting methods? Since I've reminded them that you are a CPA, what are some changes in accounting methods for tax year 2018 that we can expect to see?
I think the big thing that our tax preparers need to realize is the rules have changed on whether you can elect to do the cash method of accounting. And the cash method, in the past, you were allowed to do it in the tax return if you had an average gross receipts of $5 million or less in the last 3 years. Mm-hmm. They've actually upped that to $25 million. And it's not an average, it's $25 million in any of an aggregate in the last 3 years. So I think it's an important change. I think people need to realize it because it could seriously affect how you do prepare a tax return for your clients.
Absolutely.
So I would really recommend you not only look at the tax law changes, but some of these other changes that could affect you.
All right, we're going to leave it there.
Okay.
LaDonna, thank you again for joining us
Oh,
today.
you're very welcome, Ryan.
It was a pleasure, and we'll see you all on the next episode of the Taxing Subjects Podcast.